Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of what these companies are doing behind the fancy words public storage. Just dropped an update and it looks like they are sharing some business performance numbers for the end of last year while also giving us a peek at what is coming up. We are going to decode what these numbers really mean for the company and for investors. Before we dive in, if you're finding value in these straightforward breakdowns of financial reports, make sure you hit subscribe. And hey, if you want to join a community of folks doing the same thing, come join our Discord channel. It's linked in the description below. Alright, so Public Storage is telling us about their business up to the 31st of December 2025. They released something called an investor presentation, and that is what we are getting a look at today. Let's get right into the juicy stuff, the numbers. They've given us an update on their samey store facilities, which basically means the properties they have been operating consistently. First up, we see how many new tenants are moving in. For the last 3 months of 2025, the average annual rent per square foot for these new move-ins was $11.60. Now that might sound like a small number, but get this, it's a 10.6% drop compared to the same period in 2024. That means they are charging less to get people to move into their storage units. In terms of square footage, 30498 units moved in, which is up 2.4%. So while more people moved in, they are paying less per square foot. This resulted in contract rents gained from move-ins falling by 8.4% to $88.4 million. They are also giving out fewer promotional discounts, down 18.1%, so they are trying to attract more people but at a lower price. Now let's look at the flip side, the folks moving out. For the last 3 months of 2025, the average annual rent per square foot for those moving out was $20.12. This is almost the same as the year before, just a tiny 0.3% drop. They saw 30,043 square feet of space become available from move-outs, which is a 4.2% decrease from 2024. This means fewer people are leaving their storage units. The contract rents lost from these move-outs went down by 4.5% to $151.1 million. So fewer people are leaving, and those who are leaving were paying a slightly lower rent per square foot compared to before. What this basically means is that even though fewer people are leaving, the rent they were paying was higher than the rent being charged to new tenants. This can put pressure on overall revenue growth. Looking at the overall picture, at the end of the 31st of December last year, their square foot occupancy was 91%. This is a slight increase of 0.5% from the previous year, and the annual contract rent per occupied square foot was $22.55. This is a 0.7% decrease compared to the prior year. So occupancy is up a little bit, but the rent they are getting per occupied square foot has actually dipped slightly. This suggests that while they are filling up space more effectively, they might be doing it with slightly cheaper rental rates overall. On top of this performance, they also made some significant acquisitions. For the entire year of 2025, they bought 87 new self-storage facilities covering over 6 million net rentable square feet for a hefty $942.2 million. This shows they are still actively growing their physical footprint, even if the core operations are seeing some mixed signals in pricing. Now let's talk about what this all means. The report shows a company that is still growing by acquiring new properties, which is a positive sign of ambition and scale. However, the internal operational data for their existing stores reveals a trend of lower rental rates for new tenants and a slight decrease in average rent per occupied square foot. While occupancy is slightly improving, this suggests they might be competing more aggressively on price to fill up their spaces. This could be driven by market competition or a slower demand environment. They are essentially trading longer leases at lower rates. Looking at this filing and the numbers presented, it seems Public Storage's strategy involves significant expansion through acquisitions to boost their overall portfolio size. However, their focus on filling existing space might be leading to lower per square foot rental revenue. The key question for investors is whether this growth in acquisition volume can offset the pressure on rental rates in their existing stores. The drop in rent for new move-ins is noticeable, and it will be important to watch if this trend continues. The company is performing reasonably well in terms of keeping their storage units occupied, but they are not able to increase the rental prices as much as before. This is a delicate balance between filling space and maximizing revenue from that space. My take is that Public Storage is in a fairly stable but competitive market. They are making smart moves by expanding their physical presence, but they need to be cautious about how much they are discounting their services to attract customers. If they can hold on to their tenants and gradually increase rents when contracts are renewed, that might be a better path to sustained profitability. The significant investment in acquisitions shows confidence in the long term, but the near-term operational metrics on pricing warrant attention. It's a mixed bag of growth through acquisition and price sensitivity in their core business. Alright, that's our breakdown of Public Storage's latest update. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.